to invest. Make millions by day trading. Why not?
To China, this is trade opportunity, or are they happily going toward isolation?
I'm sure you've heard the statistic that 90% of active traders underperform the S&P 500. And if you haven't, then now you know. Today we're going to dig deeper into a time-tested technique backed by Warren Buffett that allows investors to grow their money without taking on much risk. Warren Buffett is the world's most famous investor and arguably the most successful stock picker. As the CEO of Berkshire Hathaway, his full-time job revolves around analyzing and picking winning stocks at good prices. But strangely enough, Buffett actually discourages stock picking and recommends dollar cost averaging through index funds for most investors.
In terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund. And I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index.
Here, Buffett stresses the importance of buying index funds with low associated costs. Every fund has an expense ratio, which is basically a percentage of assets that you'll pay the company to manage the fund for you, which in this case would be just to pool all the stocks together and put it in a single ticker that you can buy in the stock market. Ideally, you want this expense ratio to be as low as possible to maximize your profits over time. As per Warren's recommendations, here we have a Vanguard ETF that closely tracks the S&P 500. This ETF with ticker VOO has an expense ratio of 0.03%. On the other hand, we have an Invesco S&P 500 index fund that also tracks the S&P 500. These two funds follow the same exact index, meaning that they contain the same exact stock and the same exact percentage of each stock. They're basically mirrors of one another. However, you'd be surprised to find out that the Invesco Index Fund has an expense ratio of 1.03%. Although the difference between 1.03% and 0.03% seems negligible, it makes a very big difference over the long run. Compounded over 30 years with an average return of 12.61%, an initial investment of $10,000, plus recurrent monthly additions of $200 will grow to approximately $1 million, where you will have paid almost $7,000 in fees to Vanguard. On the other hand, with the Invesco Index Fund and the same exact parameters as before, your money will grow to approximately $800,000, where you will have paid more than $200,000 in fees. So a seemingly negligible expense ratio of 1.03% would have costed you $200,000 over 30 years for the same product that you could have gotten for only $7,000. And that's why financial literacy is so important. So make sure you subscribe right now to never miss out on any other tips like this. Now let's see what else Warren Buffett has to say.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
What Warren Buffett just explained right here is what we call passive investing. Basically, you park your money in an index fund that you believe in by consistently investing a set amount of money at predetermined time intervals, whether that be $100 bi-weekly every time you get your paycheck or $600 every quarter. It's really up to you. It's whatever works best for you. The key factor with this strategy is consistency and keeping a level head by trusting that your investment will grow in value over the long run. But if you think about it, this strategy sets you up to be completely and utterly average. Because like it or not, by consistently investing the same amount of money throughout a long period of time, you're going to inevitably buy stock at the low points, but also at the high points. So at the end of the day, if we average everything out, it's as if you bought stock at a fair price, which isn't necessarily a bad thing, but let's see if we can do anything about this through market analysis.
As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio, determines things. I don't think price-book ratios, price-sales ratios. I don't think there's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You can't. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it.
Even Warren Buffett said it himself. Time in the market beats timing the market. But we're still left with this looming gray cloud reminding you that passive investing will only lead to average results. But this really depends on how you look at it. By choosing passive investing, you have to commit a couple of hours upfront to choose the right index fund for you. And then after that, it's only 30 minutes every month to buy that index fund. On the other hand, active investing, which involves picking a winning stock and timing the market, would require more than 10 hours of work a week and consistently being up to date with what's happening around the world. By choosing passive investing, you unlock those 10 hours per week to do whatever else you want to do. And if you're not satisfied with the expected returns, then you can use those additional 10 hours per week to work on a side hustle that is going to allow you to increase your contributions every month. By increasing your contributions every month, you can drastically increase your expected returns over 30 years. And if you're not yet convinced about the benefits of passive investing, here's a final clip of Warren Buffett.
The trick is not to pick the right company, it's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way.
And there you have it. If you enjoyed this video, make sure to check out my other video where I explain how compounding works, and make sure to leave a thumbs up on this video right here. Subscribe for more.